He was standing in his kitchen, not at the stove, not making breakfast, standing at the bench, reading a letter from his super fund, one page held at arm's length, reading glasses pushed up high, the kettle behind him long since boiled and forgotten. The letter said something had changed, effective 1st of July. But the way they wrote it, dense, careful, covered in qualifications, he could not tell whether it was a small administrative update or something that genuinely mattered. So he put the letter down, went back to the kettle, poured the tea, and decided to look into it later. That was 3 weeks ago. The letter is still on the bench. If that sounds familiar, stay with me, because today I want to walk you through every significant super change that took effect on the 1st of July 2026. Not in the way the super fund letter explained it, in a way that actually makes sense. And I will be honest, there is one change in this list that affects almost every working Australian, and there is another that affects barely anyone. But the one that affects barely anyone is the one that got all the headlines. So let me start there and then bring it back to the changes that might actually matter for you. The first big change is called Division 296. You may have heard it described as a new tax on super. The headlines were dramatic. Government comes for your super, that sort of thing. So let me explain what it actually is, because the reality is more specific and much narrower than the headlines suggest. Division 296 applies an additional tax on the investment earnings inside your superannuation, but only if your total super balance across all of your funds is above $3 million. Under current rules, that $3 million mark is the first threshold. If your balance sits between $3 million and $10 million, the additional tax on the earnings from that portion is 15%. If your balance is above $10 million, and that is an extraordinarily small number of Australians, the additional rate on that portion is 25%. Now here is the part that matters most, and that was missing from a lot of the coverage. This tax is on earnings only, not on the balance itself, not on the total amount sitting in your fund, on the growth. And it applies only to realised earnings, dividends, interest, rent, realised capital gains. Unrealised gains, paper profits that have not been sold, are excluded. That was a significant change from the original proposal, and it makes a real difference. The thresholds, 3 million and 10 million, are also indexed to CPI. That means they will rise over time, which reduces the chance of more people being dragged into the measure through bracket creep. And the first assessment does not happen until your balance is measured on the 30th of June 2027, so there is time. Now, here is the honest perspective. According to the ATO, around 0.3% of Australians have a total super balance above $3 million. That is roughly 30,000 people out of more than 16 million super accounts. So if you're watching this and your super balance is in the hundreds of thousands or even in the low millions, Division 296 does not apply to you. It is worth knowing about because rules change and understanding the system protects you. But it is not something most people need to lose sleep over tonight. And what I find interesting, and this is something we have covered in detail on this channel, is that the change, which affects nearly every working Australian, got far less attention. And that change is payday super. Now, we have done a full breakdown of exactly how payday super works in another video, how the timing has shifted, what employers are now required to do, and why it matters for your balance over time. But let me give you the key summary here because it connects directly to everything else that changed on the 1st of July. Under the old rules, your employer could pay your super contributions quarterly. That meant the money could sit in their account for up to 3 months before it reached your super fund. Under the new rules, as of the 1st of July 2026, employers must now pay your super at the same time they pay your wages, and those contributions must reach your super fund within 7 business days of each payday. That sounds like a small administrative change, but here is why it matters. When your super arrives quarterly, it misses months of compounding. Over a career, over 20, 25, 30 years, that lost compounding adds up to real money. Thousands of dollars, tens of thousands in some cases. The other thing payday super does is make unpaid super much harder to hide. Under the quarterly system, it could take months before an employee even realised their employer had missed a payment. Under the new system, it shows up almost immediately because it is tied to your pay cycle. The super guarantee rate itself, the percentage your employer is required to contribute, stays at 12% for this financial year. That has not changed. But combined with the shift to per payday contributions, it means your super should now be arriving more frequently and more reliably than it ever has before. Now, here is where most explanations stop. But there is a second layer to this that changes everything for people who are approaching retirement, and that is the contribution caps. Stay with me on this next part, because this is where the real planning opportunities live. The concessional contributions cap, That is the total amount of before-tax money that can go into your super each year, including your employer contributions, salary sacrifice, and any personal contributions you claim a deduction for, has increased to $32,500 for the 26-27 financial year. Why does that number matter? Because it sets the limit on how much you can put into super at the lower tax rate. Contributions that go in under that cap are taxed at 15% inside the fund, which, for most working Australians, is significantly less than their marginal income tax rate. We have walked through exactly how that tax difference works in our video on super tax at 60, and the numbers genuinely surprise most people because the discount is larger than they expect. The non-concessional cap, that is after-tax money you contribute yourself, is now $130,000 per year. And if you are under 75 and your total super balance is below 2.1 million, you can use the bring forward rule to contribute up to $390,000 in a single year. The transfer balance cap, the maximum amount you can move into the tax-free retirement phase of super, has also increased. It is now $2.1 million. If you had not previously started a retirement income stream before the 1st of July 2026, your personal transfer balance cap is $2.1 million. If you had already commenced a pension, your personal cap may be lower. It depends on how much cap space you had used. That is genuinely worth checking through your MyGov account or with your fund because the calculation is specific to your situation. And here is a piece of this puzzle that most people miss. The interaction between these caps and the age pension. Your super balance does not just determine how much tax you pay inside the system, it also determines how much pension you receive outside the system. The assets test, the income test, the deeming rates, they all take your super into account once you reach age pension age. That relationship between your super and your pension is one of the most important and least understood parts of retirement planning, and it is something we go deeper into in another video, because getting it wrong costs real money. Now let me talk about one more change that does not get enough attention, and that is the minimum drawdown rates. If you're already retired and drawing an income stream from your super, an account-based pension, you're required to withdraw a minimum amount each financial year. That minimum is a percentage of your balance, and it increases as you get older. Under 65, it is 4%. Between 65 and 74, 5%. 75 to 79, 6%. And it continues to step up from there. For the 26-27 financial year, those rates have not changed. They remain at their standard levels, but here is why I am mentioning it. Because during the pandemic, the government halved those rates temporarily. That reduction has now fully expired, so if you had been drawing at the reduced rate, your minimum has effectively doubled compared to what you were withdrawing a few years ago. That catches people off guard, and it is worth checking with your fund to make sure your drawdown is set correctly for this financial year. And I will say this, watching your super balance go down each year, even when you know it is the design of the system, feels wrong. You spent decades watching it go up. Every statement, a little bit higher. Now it has to go down, and your instincts resist it. That is not a financial problem. That is a perfectly normal human reaction. We have talked about that feeling on this channel before, and understanding why it happens genuinely helps. Right. So let me bring all of this together, because these changes do not exist in isolation. They are part of a system, and the system has a shape. If you're still working, the changes that matter most to you are payday super and the increased contribution caps. Your super is now arriving every pay cycle, and the amount you can salary sacrifice or contribute personally has gone up. That is an opportunity, especially if you're in your 50s or 60s and trying to maximise what you have before retirement. If you're already retired, the changes that matter are the transfer balance cap increase and the return to standard drawdown rates. Check your cap space. Check your drawdown settings. And if you are on the age pension, check whether any of these changes have affected your assessment, because even small shifts in your super balance can change what the income and assets tests calculate. If you want to check any of these figures, the ATO website, ato.gov.au, has the current contribution caps, and Services Australia, servicesaustralia.gov.au, has the latest pension rates and test thresholds. And if you are unsure about how any of this applies to your situation, talk to a qualified, independent financial advisor, someone who charges a fee for advice, not a commission on a product. But there is something else worth exploring, something that connects directly to what we have covered today. All of these changes, the caps, the rates, the thresholds, exist inside a broader environment where the cost of living is rising faster than most people expected. The pension is indexed, but has it kept pace with what retirees actually experience at the checkout and the letterbox? That gap between the official numbers and the lived reality is something we have unpacked step by step, because the numbers tell a story that does not always match the headlines. If this helped make sense of something that felt confusing, share it with someone you know who has been putting off reading that letter from their super fund. Sometimes all it takes is someone explaining the system in plain language. And I'm curious, did you know about all of these changes before today? Or was there one in this list that caught you by surprise? Tell me in the comments. I read every single one, and your questions genuinely shape what I cover next.